What causes every financial crisis? The air on Wall Street was thick with tension as the stock market, once an unstoppable force of wealth and ambition, began to crumble. It was October 29, 1929, a day that would forever be known as Black Tuesday. In just a few hours, fortunes vanished, and men in crisp suits stood in disbelief watching stock prices plummet. The trading floor erupted into chaos, panic spreading like wildfire. For years, America had been riding high on the wave of the Roaring Twenties, an era of soaring stocks, easy credit, and boundless optimism. Everyone wanted in. Ordinary people poured their savings into the market, believing that stocks could only go up. But beneath the surface, danger loomed. Speculation ran rampant, and banks, hungry for profits, recklessly lent money to investors who had no means to repay. The market had become a fragile house of cards, and on that fateful October day, it all came crashing down. As stock prices collapsed, the domino effect began. Banks heavily invested in the market failed one after another. Families rushed to withdraw their life savings only to find locked doors and empty vaults. Businesses crumbled, jobs disappeared, and unemployment skyrocketed to a staggering 25%. Red lines stretched for blocks. In rural America, farmers lost their land to ruthless foreclosures, while the Dust Bowl turned once fertile fields into barren wastelands. The Great Depression rippled across the globe, shattering economies from Europe to Asia. Nations turned inward, raising tariffs in desperate attempts to protect themselves, but instead suffocating global trade. For years, governments scrambled for solutions. In America, President Franklin D. Roosevelt launched the New Deal, a bold experiment of public works, financial reforms, and social safety nets. It was a lifeline, but recovery was slow. Ultimately, it wasn't tea policy but war that ended the Depression. The outbreak of World War II reignited industry, fueled mass employment, and restored economic stability. The 1973 oil crisis struck silently but with devastating force. The Organization of Arab Petroleum Exporting Countries, OPEC, turned off the taps, imposing an embargo on nations that supported Israel during the Yom Kippur War. Almost overnight, the world's most powerful economies found themselves gasping for fuel. Oil prices quadrupled, jumping from $3 to nearly $12 per barrel. Gas stations in the United States became battlegrounds, with endless lines of desperate drivers snaking around blocks, waiting hours for a ration of gas. The crisis sent shock waves through the global economy. The cost of everything from food to transportation skyrocketed. Businesses crippled by soaring production costs cut back on operations, jobs vanished, and inflation soared. Economists scrambled for answers as the world faced a terrifying new reality. Stagflation, a rare and devastating mix of stagnant growth, rising unemployment, and runaway inflation. Industrialized nations had long relied on cheap Middle Eastern oil, but now that dependency had turned into a vulnerability. Governments were forced to rethink their energy strategies, pushing toward fuel efficiency, alternative energy sources, and strategic oil reserves. The power dynamic had shifted. Oil-exporting nations, once seen as suppliers, had become economic kingmakers, holding immense leverage over the world's most powerful economies. The 2008 global financial crisis began with a dream: homeownership for everyone. In the early 2000s, banks and lenders fueled an unprecedented housing boom, handing out mortgages to anyone who asked, even those with shaky credit. Home prices soared, and Wall Street saw an opportunity. Instead of questioning the house of cards they were building, financial institutions doubled down. Banks bundled risky subprime loans into complex financial products called mortgage-backed securities, MBS, and collateralized debt obligations, CDO. These were then sold to investors around the world, stamped with AAA ratings by credit agencies that either didn't understand or didn't care how fragile they really were. For years, the system seemed unstoppable. Investors profited, banks thrived, and homeowners believed prices would never fall. But cracks began to show in 2006 when housing prices peaked. As values dropped, homeowners found themselves owing more than their homes were worth. Mortgage defaults surged. Then came 2008, the year the world unraveled. Lehman Brothers, a giant investment bank, collapsed overnight, sending shock waves through global markets. The financial system, built on bad debt and reckless speculation, froze. Banks stopped lending, stock markets nosedived, and trillions of dollars vanished. Governments scrambled to prevent total economic collapse. The U.S. government poured $700 billion into failing banks through the Troubled Asset Relief Program, TARP. Central banks slashed interest rates to near zero, and stimulus packages flooded the economy in a desperate attempt to restore confidence. But for millions, the damage was done. Homes were foreclosed, jobs disappeared, and savings evaporated. The crisis plunged the world into a deep recession, exposing the greed, poor oversight, and systemic fragility that had fueled the meltdown. In early 2020, the stock market was unstoppable. The S&P 500 and Dow Jones were soaring to record highs, fueled by a strong economy and investor optimism. But in the shadows, an unseen threat was spreading. In late 2019, news of a mysterious virus emerged from Wuhan, China. At first, few paid attention. The markets shrugged off the headlines. But as February 2020 arrived, the virus spread beyond China to Italy, Iran, and the rest of the world. What seemed like a distant health crisis suddenly became a global emergency. Then came March, the month the markets crashed. Panic erupted as governments locked down entire economies. Businesses shuttered overnight, supply chains froze, and investors fearing a worldwide recession rushed for the exits. Within weeks, stock markets crumbled. The Dow Jones suffered its three worst single-day point drops in history on March 9th, March 12th, and March 16th, falling nearly 13% in a single session. These days became known as Black Monday, Black Thursday, and Black Monday again. Just when it seemed things couldn't get worse, an oil war between Saudi Arabia and Russia sent oil prices into freefall, adding more fuel to the fire. It was chaos, but governments and central banks fought back. The U.S. Federal Reserve slashed interest rates to zero and unleashed massive stimulus programs. Congress passed the CARES Act, a historic $2.2 trillion rescue package that sent direct payments to citizens and propped up businesses. Around the world, policymakers scrambled to contain the economic fallout. Despite the devastation, something extraordinary happened. By April, whispers of vaccine development and the rise of the stay-at-home economy led by tech giants like Amazon and Zoom sparked a historic rebound. Stocks climbed at a record pace. By August 2020, the S&P 500 had fully erased its losses, marking the shortest bear market in history. But beneath Wall Street's recovery, Main Street was suffering. Small businesses collapsed, unemployment soared, and the crisis exposed a deep disconnect between financial markets and the real economy. The COVID-19 crash wasn't just a financial meltdown. It was a reminder of how fast fear can spread, how crucial government intervention can be, and how unpredictable the global economy truly is. Because in 2020, the markets didn't just fall, they plummeted, rebounded, and left the world forever changed. History has shown us again and again that no economy is immune. Crashes happen fast, recoveries are slow, and the lessons are often forgotten. So the question remains, what will trigger the next collapse? Make sure you stay prepared. The world moved on from 2020, but the scars ran deep. The financial system, once again patched up with emergency measures, seemed resilient until it wasn't. By 2025, a new crisis was brewing, one that no one saw coming. It started subtly, with whispers of a shadow economy operating beneath the surface. Cryptocurrencies and decentralized finance, DeFi platforms had grown exponentially, promising anonymity and freedom from traditional banking systems. Governments and central banks watched warily, but the allure of instant wealth and the promise of financial sovereignty proved too tempting for many. In early 2025, a series of high-profile DeFi platform hacks began to surface. At first, they were isolated incidents, dismissed as teething problems in an emerging market. But then, the attacks escalated. Billions of dollars in digital assets vanished overnight, and confidence in these new financial systems crumbled. The contagion spread quickly. Banks that had invested heavily in crypto assets found their reserves depleted. Traditional markets, already jittery from economic uncertainties, began to wobble. Stock prices fluctuated wildly as investors panicked, unsure whether the next hack would drain their savings or if the entire system was on the verge of collapse. Governments and financial regulators scrambled to respond, but the decentralized nature of these platforms made it nearly impossible to trace the culprits or halt the bleeding. Central banks, fearing a repeat of 2008, pumped liquidity into the markets, but this time, the injections seemed to have little effect. The shadow economy had become too intertwined with the mainstream financial system. As trust eroded, so did economic stability. Businesses that had embraced crypto assets found themselves in a cash crunch, unable to meet their obligations. Layoffs and bankruptcies became commonplace. Unemployment rates soared once more, and consumer confidence plummeted. The crisis exposed a new vulnerability: the interconnectedness of global financial systems in an age where digital assets were as real as physical currency. The lines between traditional finance and the crypto world had blurred, creating a web of dependencies that no one fully understood until it was too late. Governments around the world convened emergency sessions, but the solutions were elusive. Some proposed draconian measures to regulate or even ban cryptocurrencies, while others advocated for more lenient approaches to foster innovation and security. The debate raged on, but the markets